fastest growing sports in America. Participation is exploding. Courts are everywhere and has gone from a backyard pastime to a full-blown commercial opportunity almost overnight. That is exactly why investors should slow down. When an industry grows this fast, the business model often gets built after the excitement. Pickleball franchises are a perfect example of that risk. Right now, there are roughly 8 pickleball franchise systems operating in the United States. Just a few years ago, there were 0, none. According to the founder of Ace Pickleball Club, the industry is in the middle of a pickleball franchise gold rush, a race to grab territory and sell locations as quickly as possible. Collectively, these brands are projecting more than 1,000 locations sold by the end of 2025. That number should raise eyebrows. Rapid expansion does not mean the economics are proven. It often means franchisors are selling first and then figuring things out later. We reviewed the FDDs of about 5 pickleball franchise systems. The investment ranges are eye-opening. On the low end, one concept requires roughly $800,000. On the high end, another exceeds $2.4 million. This is not a low-risk startup cost. This is institutional-level capital being deployed into businesses that in many cases have not existed long enough to experience a full economic cycle. The biggest cost driver is real estate. Most pickleball franchises require between 10,000 and 35,000 square feet. That means expensive construction, costly leasehold improvements, and long-term commercial leases in spaces that are not easy to repurpose if the concept struggles. Let's put some real numbers to it. Assume your total investment is $1.7 million. Using an SBA loan, you are likely required to inject around 20% in cash, roughly $340,000. You personally guarantee the loan. Then you sign a long-term lease, often 5 years or more, with another personal guarantee tied to monthly rent. If the business underperforms, there is no clean exit. You can't just walk away. You're on the hook. And this is where optimism usually kicks in. Big risk, big reward, right? But here's the problem. There is very little evidence yet that the reward justifies the risk. Pickleball franchises are extremely young. Most do not disclose any financial performance in their Item 19 of their FDD. That alone should matter. If the numbers were compelling across the system, they would likely be disclosed, right? A few brands provide limited data. Some show results from an affiliate location, others disclose a handful of franchisees that have been open for a year or so. But that is still thin data set to be betting 7 figures on. Let's look at what we do know. The Pickler franchise provides the most financial disclosure. They report 4 locations that were open for at least a full year as of June 2025. The average revenue across those locations was just over $1.1 million. That sounds strong, until you remember the investment range, which runs roughly from $1.2 million to $2 million. And revenue does not equal profit. Once you layer debt service, rent on a massive facility, payroll, utilities, insurance, marketing, maintenance, the margin for error shrinks quickly. A business can look impressive on the top line and still struggle to meet and generate meaningful cash flow for the owner. Pickleball Kingdom discloses financials for an affiliate location in Arizona that generated around $1.86 million in gross sales in 2024. That facility spans roughly 37,000 square feet. Again, impressive revenue, but massive overhead. The real question remains unanswered. After loan payments and operating expenses, what is the owner actually keeping? Normally, you answer that question by talking to seasoned franchisees. That is where the pickleball franchises hit yet another wall. There are not many seasoned franchisees. Most owners are still early. Some are still ramping up. Some may not have even reached break-even. Others haven't even opened yet. The sample size of stabilized, mature operations is extremely small. That makes these franchises less like a proven business model and more like a forward-looking bet on where the sport might be in 5 or 10 years from now. And that's fine if you know that that's what you're doing and what you're getting into. Pickleball franchises may make sense for high net worth investors who are comfortable taking on significant risks, tying up capital, and being early to a category. They are far less appropriate for buyers looking for a predictive cash flow, a quick path to profitability, or a lower risk entry into business ownership. Pickleball's booming, the excitement is real, the growth is undeniable, but from an investment standpoint, this space is still largely untested. When you are committing hundreds of thousands in cash, personally guaranteeing 7-figure loans, and locking yourself into long-term leases, hype is not enough. In franchising, trends come and go. Debt leases and guarantees stick around a lot longer. The smartest move is not asking how fast the industry is growing, it's actually asking who is actually making money. How long did it take them to get there? And what happens if the growth slows? Right now, those answers are still very hard to find. We help prospective buyers independently evaluate franchise opportunities so they can make informed decisions, not emotional decisions. So reach out to us at franinspect.com or click the link above.